The crypto markets are hot right now, XRP is back in the headlines, and it seems like we're all anticipating a whole lot more to finish up the year. Here's a fact. You won't be able to time the top. Another fact. You can choose your sale price, estimate the taxes, minimize the taxes, and have an entire plan to optimize your wealth accumulation without timing the top. Because more money means more problems, and more gains means more taxes. So if you're holding XRP right now, you have to be planning your tax strategy upon exit or risk riding the euphoria back down to the bottom for the next cycle. So today, we're gonna teach you exactly how to do that. How to cash out your XRP in crypto without a life-ruining tax drag. If you haven't seen me before, I'm Anthony Price, CPA with Altcoin Pro, where I teach crypto investors how to outsmart taxes and legally grow and protect your wealth. My daily is working with hundreds of entrepreneurs and crypto investors to implement this knowledge. We teach this comprehensively through the Crypto Tax Mastery course inside of Altcoin Pro, and you can reach me directly in the description links if these ideas inspire questions. A quick outline for you. We'll start by framing your exit with the proper understanding of the playing field and rules of the game. Then we'll sequence your exit with timing, understanding tax cliffs, and combining with other sales or losses. Then we'll avoid taxes by implementing tax and wealth strategies and evaluating your residence status. Then we'll avoid taxable gains in the first place with a crypto version of the buy, borrow, die strategy. Then we'll have a quick review of the red flags and things to look out for. So let's get started. I've got some unique details to share, and these strategies might just save you half or more of the taxes you otherwise would have paid. And stick around. I've got nuance and warnings you might not have heard before. First is framing your exit. I always say the start of tax planning is understanding the pieces on the board and the rules of the game. That means you need to understand your tax return, your income mix, and the deductions and credits you're eligible for, plus the rules around crypto taxes. Once you have this, you can make decisions. But first, know whether your gains will be short-term, which is held 12 months or less, taxed at ordinary income rates up to 37% and potentially the 3.8% net investment income tax, or long-term, held over 12 months, taxed at the preferential 0, 15, or 20% federal bands where the net investment income tax may still apply. And again, don't forget the states. California can add 13.3%. New York City residents can approach nearly 15% combined with New York State. And also, understand tax cliffs, like the net investment income tax threshold, credit phase outs, state surcharges. Like build a bracket map before you sell. So framing your exit checklist is knowing the basics of crypto taxes, knowing short versus long term and where you'll land this year, knowing your broader tax situation. Do you have W-2 income, K-1s coming in, rental or business income, knowing your crypto situation, your realized versus unrealized gains and losses, or staking income, or the basis of your crypto by lot, right? Whether you're gonna use specific identification or FIFO method of accounting. How about rules on estimated payments and safe harbors? That's 90% of your current year tax you need to pay quarterly, or 100 or 110% of your prior year taxes depending on your total income. You should know about penalties. What is that underpayment penalty, which can add about 4% to your overall taxes? How about the late payment, where if you don't pay for months, you could add 10 to 15% to your tax bill, or late filing, which could add up to 25% to your tax bill. Plan your cash to avoid these penalties. And here's a recommendation for tax payments. Run a conservative estimate, schedule your quarterly payments, and make sure you know and use those safe harbors to avoid penalties. Next is sequencing your exit. Understand the concept of tax cliffs and avoid tripping into higher bands when possible. Examples would be that long-term capital gains are taxed at 0% when you have under $95,000 of married filing jointly income, or about $47,000 filing single. That means if you add the standard deduction of $30,000 jointly or $15,000 single, that you can literally have $125,000 of long-term capital gains income as a married couple and pay no taxes if you have no other income. And it works for single under $62,000 of income. Another strategy is splitting your gains across years, like tranche your sales in late December and maybe early January to spread your income. Maybe you're a married couple that makes $75,000 a year, you have $100,000 of gains to recognize. If you do it all in 1 year, you're gonna pay 15% on $50,000 of those gains. If you do some in December and some in January, assuming no other income besides the $75,000, that would keep you at that $125,000 married filing jointly range, where you go from paying 15% to literally 0%. That's a $15,000 tax difference we just planned out. Next is pairing gains with losses harvested elsewhere, like stocks, other tokens, or funds. Because wash sale rules currently do not apply to crypto. Crypto is treated as property, not stocks or securities. But keep receipts and watch for legal changes. You could use specific identification to choose highest basis lots for big sales. Remember, if you can't adequately identify, the default is FIFO, and adequate ID is the wallet address, timestamps, acquisition price, and which units you sold. Make sure you document the specific identification across your exchange and DeFi stack for 2025 and going forward. Now, next up is tax strategies that erase gains in cleanup basis, but only if you do the paperwork right. Now, almost all tax strategy involves trade-offs, restricting how you use assets or reallocating capital. There's no free lunches. A fake church, tax fraud. A tax-free trust that hides income is tax fraud. Legal strategy is effective decisions that fit your life and wealth goals. So if you start a business this year, legit expenses and depreciation can help, but don't force it. How about short-term rentals? Under the right participation rules, losses may offset other income from a short-term rental property. It's powerful but detailed. I'll cover it in a separate video on my personal channel. About charitable strategies, if you already give or want a legacy, donating appreciated crypto can add so much leverage. Consider donor-advised funds for simplicity, private foundations for long horizon giving, charitable remainder trusts for lifetime income. Remember, a qualified appraisal is required for crypto donations over $5,000. Screenshots aren't enough. Now, how about residence changes? Because moving from LA at 13.3% to Las Vegas at 0% may be worth it for some of you. But realize, moving for tax is not a weekend errand. You're not a South Dakota resident even if you got a South Dakota license after 3 days visiting. States look to closest social and economic ties. It's your home, how many days, where your family is. Do you have a license? Do you have voter registration? Do you have memberships to gyms? Do you go to church? Places like California will happily subpoena, sell, and bank records to argue you never left. So if you're moving, actually move. You can go and visit, but you can't maintain your domicile where you moved from. Under Act 60, Puerto Rico taxes you 0% on your portfolio, like your interest, dividends, and capital gains income, and only 4% on your corporate income. But understand it's not always so easy for US investors, because broadly, your post-move appreciation is gonna benefit, but your pre-move appreciation sometimes is US taxable under sourcing rules. So plan before the run-up you intend to realize. Also be mindful of the time limits of having to be there. Now, I'm personally interested in the Puerto Rico strategy myself. I don't even have a wife or kids, I work online, and I like traveling abroad, so I could go to Puerto Rico for like 4 to 6+ months per year, a few months abroad, and a few months traveling home for the holidays in winter and summer to spend the much needed time with family. I understand how this may not be feasible for people, especially those with families, and here's the other side of the residency conversation. I've observed that clients in California have this extraordinary knack for working with companies that offer equity compensation that lead to unexpected millions, tens of millions in wealth. Like imagine getting a job for NVIDIA. Imagine getting a job for Palantir. Seriously, I had a client that worked for Palantir in the 2010s making less than 6 figures for just a couple years, now worth nearly 8 figures. And those opportunities are simply not as abundant in Reno, Nevada than in San Francisco, California, as much as I'm a Nevada guy myself. Go Wolfpack. Next is how reinvesting your gains can defer tax on your XRP gains and even put your reinvested assets onto a path to 0% federal taxes too. And that's opportunity zones. They're a good idea if it fits your goals. If you want to sell crypto, defer the gain, and diversify into real assets or operating businesses, a qualified opportunity fund is worth a look, especially after the 2025 updates. So here's what changed. The Opportunity Zone program has been made permanent, so there's no more 2026 cliff like there used to be. The deferral lasts for 5 years from your fund investment date. If you hold for 5 years, you get an automatic 10% step up in basis on the deferred gain, which reduces what you'll recognize. Then the 10-year rule remains. So if you hold your fund interest for over 10 years, you get to exclude tax on the fund's appreciation at exit. There's also new rural incentives via qualified rural opportunity funds in 2027 and on. Designations refresh starting in 2027 and then every 10 years. So timing, you generally have 180 days from when the gain is recognized to invest the gain into a qualified opportunity fund. And multiple tranches equals multiple clocks. So within 180 days, invest up to the gain into a qualified opportunity fund and document the election. Then track your 5-year and 10-year holding clocks. Plan for liquidity after year 5 recognition, after the 10% step up. Here's an example. You sell Ripple with a $500,000 gain and invest $500,000 into a qualified opportunity fund within 180 days. After 5 years, you recognize $450,000 in gains. That's a 10% shaving on your gain. After 10 years, if your opportunity fund stake grew from $500,000 to $800,000, that's $300,000 in appreciation that can be excluded on the exit. That's all of it. Now understand, State conformity varies, like California historically doesn't conform, so plan for the state taxes. Qualified opportunity funds are generally illiquid and manager dependent, which means you're going to make money only if the manager is good. So diligence the 90% asset test, working capital plans like audit the financials, watch for inclusion events, make sure this is not a bad fund. Now, for those of you thinking, I don't even want to sell yet, the next move gets you cash without selling. But with fine print, no one tells you. So here's how to avoid taxable gains with the crypto version of the buy, borrow, die. You've probably seen the meme of how you buy assets, you borrow against them, and then you die, get to step up in basis. Here's the full version, how it actually works and where it bites. So if you buy and hold, there's no tax until you dispose. Now, if you borrow against it and don't sell, you can pledge your Ripple as collateral and borrow USD or stables. Now, borrowing is not a sale, so no capital gain on your funding. But if your collateral is liquidated, that's a taxable disposition at fair market value. If you repay with appreciated crypto, that repayment is a taxable disposition of those coins. So keep your loan to value conservative and repay in cash and stables when possible. How about interest deductibility? If it's for personal use, it's generally not deductible. It's personal interest. If it's for investment use, it may be deductible up to the net investment income on Form 4952. If it's business or rental use, it most likely is deductible. It just follows the activity rules, so maybe the passive or at-risk limits may apply. So translation, unless the proceeds fund investments or a business, assume the interest is not deductible when taking loans out against your crypto. Now, when you die, under IRC Section 1014, heirs generally get a step up to fair market value, wiping built-in gains at death. So pair borrowing with real estate planning. Don't wing it off of Twitter. The bottom line, buy, borrow, die can provide liquidity without selling, but it's not a free lunch. Respect the cost of interest. You have to pay interest on the loan against it, plus the liquidation risk and the basis at death rules, or it turns into expensive leverage with the meme name. Respect the cost of interest, liquidation rules, and the basis at death rules, or else it turns into expensive leverage. Now, let's have a quick conversation on things to look out for and potential red flags for your crypto reporting in 2025. Here's a myth. Every swap counts. It's not taxable if I don't cash to USD, right? Wrong. Dispositions are sales, trades, or spending your crypto. Understand you need crypto accounting software. Wallet level basis tracking is now the standard. You can no longer track your wallets using the universal approach, so you need a crypto accounting software. Understand the 1099 DA is here, so brokers are going to report your gross crypto proceeds for 2025 transactions. Basis reporting phases in starting 2026 for the same assets, so align your Form 8949 to what the IRS receives. No documentation is important. Keep your CSVs, lot workbooks, specific ID memos, your staking income logs. And understand with foreign accounts and brokerages, non-US platforms can trigger the FBAR, foreign bank account reporting. They could trigger FATCA, foreign asset reporting. And the penalties are severe. For non-willful, up to $16,536 per year, that's inflation adjusted, or for the willful, the greater of nearly $166,000 or 50% of the account balance per year, plus potential criminal exposure. So when you have international assets, make sure you file on time. So let's make a summary of what you have together before you sell. First, basic crypto tax knowledge. Second, understand your own tax returns and circumstances. Plan your estimated taxes. Third, a current view of your crypto portfolio. Use a software. 4, a preview of what you'd incur if you sell, plus options to realize losses elsewhere. 5, a timeline for sales and expected tax impacts. 6, professionals on your team. That's a CPA or EA, an attorney, a planner. 7 is a documented tax plan. 8 is appraisals for any charitable donations or residency evidence or your qualified opportunity fund or zone subscription docs if applicable. Then there's relationships for crypto loans if you'll borrow. We have many OTC partners like SDM and many others that can help. And finally, all your crypto documentation, including IRS source docs issued in your name. So when the pump comes, it's more important to take your profits and plan for the taxes than it is to wait forever trying to perfectly time the top. That's how I and most other investors lost basically entire portfolios in 2021 to 2022 when the meltdown came. If you follow these steps, you can exit cleanly while offsetting tax drag and building a legally sound plan to grow and protect your wealth for the rest of your life. So subscribe for weekly XRP tax tactics, grab the Crypto Tax Mastery course inside of Altcoin Pro, and if you need personalized attention, book a free strategy call linked below. I'm Anthony Price, CPA with Altcoin Pro, helping you outsmart taxes and build wealth. See you next time.